Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, March 5th, 2019. We'll keep this one quick. We had another red day right now in the S&P 500, and so where the significant lies are potentially is it's additional confirmation to the bearish engulfing candles I pointed out yesterday. We had bearish engulfing candles on both SPY and IWM, the small cap index. Actually, quite a few indexes and sectors as well. I did a video today for members of the site covering XBI, the biotech ETF, and some top components, as well as XLV, the healthcare ETF, because they're both closely related. Both of those big bullish engulfing candles, and I went back a couple years and highlighted quite a few tops, which came with bearish engulfing candles and then decent corrections afterwards. So again, there's still work to be done. Here's the bottom line. And you can look at it glass half full, glass half empty. Most people will do so, whatever they want to see. But right now, we're in a stalemate. The market has moved sideways, so really nobody's won or lost for the past, it's been exactly 2 weeks, as a matter of fact, because if I take today's candle and I come back here all the way to the top of the candle on the 29th, that's 14 days ago. I'm sorry, the 19th, February 19th. So you can see we closed right about at the highs on the 19th of February, and that is 14 days ago. So that's where we're at right now. That's the bigger picture. Market's not going up, but it's not going down. And more importantly, that's not the entire story. It has stalled right at major resistance. So it's yet to be seen. Will this just be another consolidation period like we had back here, followed by a breakout to new highs, or will it be a failure, at least end of the run for the time being, possibly more, like I've cited recently? If you haven't caught my recent videos, we have a high-level bearish PPO crossover. I'd have to zoom in here. I want to keep this video short, but I've gone over in quite a few of those when you have clean separation in the PPO, and you get one of these high-level bearish PPO crossovers. I'm referring to, a lot of distance above the zero line like that. It often gives you some pretty good sell signals, as you can see there. The resistance, of course, which probably, if I had to pick just one thing on this chart, that would be one of those, but you can't. It's not any one thing. Resistance on early levels is expected to and was smashed through. So when you have a very extended overbought rally, which still may prove to be a bear market rally, only time will tell, you have to respect rallies into resistance like this. 50 and 200 day, 50 is coming up to test the 200 day exponential moving average, that is. That's pretty much it on the daily time frame. Actually, no, it's not, because sometimes I'll do these videos. I don't update the weekly and monthly long-term charts all the time, because there's not, especially when you stall out. We've stalled out for the past 2 weeks. We've gone nowhere, as I just showed you. So you're not going to have any significant developments on the weekly time frames. You need to see some movement in the market. However, let's not forget the bigger picture, and that is this. We zoom out here. Let's go over here, 2-day chart. This is the bigger picture. This is I should say 4-year chart. Here's that trend line off the early 2016 lows, clean trend line. There's a break, big rising wedge, divergent top breakdown. Of course, you had some indexes not here on the SPY. This is a 2-day period chart. I just flipped the candles to 2 days, so it's distorting. This is not what the MACD and RSI look like on the daily. We did have divergence on the RSI and SPY, but that's it. So the divergence prompted the rally, boom, right back into resistance. And again, I keep focusing on those Q4 highs from last quarter, but we also had a reaction high back here, as I pointed out before. Once we broke above that reaction high, it became resistance, became support. It was tested for several weeks back there, maybe even a couple months. And again, the recent highs there. So pretty significant level. And again, this is a bigger picture. You have a breakdown. And is that correction over, or is there more to come? Only time will tell. And here's what it looks like on the really big picture. Remember, on the site pointed out today that tomorrow will be the 10-year anniversary of this bull market. Yeah, how time flies. March 6th, that's when the S&P 500 and just about every other index, the NASDAQ 100 actually bottomed back in, what was it, was in the fall of 2008, and then made a higher low on that March 6th low. But this is where every other index bottomed, so that's the official start of the bull market. But there's your bigger picture. There's your bull market uptrend line. Lots of reactions along the way. Reactions, breakdown, kickback, rally, and again, to be determined. The trend indicator is still bearish. But there's some bullish stuff, some things that didn't hold. So, like I said, it's anybody's game at this point. And so let's just right now keep an eye on that daily time frame, because not a lot's happening right now in the weekly time frame worth pointing out. I just figured we'd do a quick recap. And of course, here's QQQ. This is a weekly chart going back to that mid 2015 reaction low right there. So you come in off the 2015 low, you have quite a few reactions along that trend line to validate it, breakdown, kickback, rally so far, and we're still well off the high. So you know, what somebody mentioned in the trading room, would it be, you know, tomorrow mark a 10-year bull market? Well, no, technically no. I looked at kind of the S&P 500 would have to pop 5% tomorrow and then reverse, or just pop 5% to keep the market going. As of now, the top is last fall. Again, we're so close, but we are still 5% shy. So again, you know, only time will tell. Was this the end of the bear market off the '09 lows? Or will we pop those highs sometime in 2018 here, maybe sometime soon? Who knows? But again, that's where we're at. I just wanted to point that out. We will not make it tomorrow, at least, to put in a new high. Okay, so I pointed out yesterday's bearish engulfing sticks on most of the indexes. A lot of sectors. QQQ didn't have it, and just like yesterday, QQQ closed green, although slightly. I call 0.07% close a flat close for all intents and purposes. It's really basically flat. Now, and I've been watching the action closely. Yesterday, I didn't mention it in the video I posted on the site when I posted yesterday's market wrap video. Every single index, all of them, except QQQ, closed red yesterday. So, and what that was, I watched I have a watch list of all about 103 components of QQQ, and it was today it was two stocks for the most part. It was Alphabet, GOOG, and Facebook. You take those two out, we would have had a solidly red close today. Alphabet was up, well, the Class A shares 1.37%, the other share class 1.2, Facebook 2.32. Facebook, and what's going on in this market now is just still we're seeing that a surge of buybacks, and I've read about this. I believe this to be true, that the majority of the gains, this rally that we've had off the lows, are driven by share buybacks. In fact, Facebook just announced in December, they came out and announced another 9 billion. I think it was 9 billion. Hold on, let me see. I might have that article up somewhere. No, but I think it was 9 billion more in buybacks. So no doubt that a good part, maybe can't say all of it, but a good part of the gains, and we've been seeing in the last couple of days, are probably from those buybacks. But either way, take it for what it's worth. I mean, you got to take the price action on face value. It is what it is. But let's see. So we had the bearish PPO crossovers, oversold conditions. I wanted to get to the what's driving. Again, it's just a handful of stocks that prevented, again today, the QQQ bucking the trend and closing red like those other indexes. As I mentioned, even the NASDAQ Composite and QQQE, the equal weighted, were red yesterday. This is QQQ if you take away that abnormally large weighting that those top handful, the top 5 components have. Even the top 10, it goes kind of down the list from there. But look at that big red bearish engulfing on QQQ equal weighted. So again, if you apply an equal weighting to every stock in the NASDAQ 100, put in a big bearish engulfing. So right now, market breadth, internals are deteriorating is what I'm trying to say. There was just two stocks today that single-handedly, you can't argue that, look at the math, push the Qs red, and so you can look at it one of two ways. Leaders have some strength, but only a couple leaders. It wasn't even that. I look at the my watch list here on another page. I have to type in QQQ. Yeah, all the rest were down. Microsoft, Apple, Amazon, Intel. Go down the line. All right, so one more chart. Yeah, let's wrap it up here. We'll keep it simple again. Let's try not to, squeeze blood from a stone, or water from a rock, however you want to say the expression. Market's going nowhere. So, bears can't high five, bulls can't high five for the last 2 weeks. But this is SPY on a 60-minute chart. And again, I've been watching now for, about that long. I want to see these lows get taken out. I keep talking about that reaction low on that was February 21st, and you can see now we came in and made a near test of it recently, so that's shaping up to be what I think is a pretty important level. We already broke down from the wedge, but really not anything impulsive. It's just been a sideways trend, but we have broke down from that wedge off the lows on the 27th. That's what I'm talking about, the one I'm focused on. And you know, the divergences were in place and all that good stuff. So breakdown there, first target be 273, and then we'll see what it looks like from there if we go down. And of course, what the bulls want to see is an impulsive break above the highs, going back to that daily chart. We'll just end there, even though we started out on that chart. That would be, you know, right around that, what is that level? Call it 282 or so. That's what the bulls want to see. So, you know, consolidation, I'll say this, is a good thing after such an extended run. It helps to work off the overbought conditions. It takes a lot of spent fuel to get up here, and so you need to consolidate. So, you know, looking, you know, the bullish scenario would have us consolidating. Pullback would be even healthier. You know, dissipate some of the overly bullish sentiment, charge up some more bears, get some more shorts in, and that would then provide, or could provide, the thrust needed for a breakout of that level, sustained run up to new highs. And of course, I've talked about the, you know, scenario is still very much a possibility that this was just a bear market rally, and if so, and that will start to tell us, you know, as we come and slice through levels, which I'm drawing here, that should come in and act as resist or support on the way back, the 200-day moving average, the 50-day moving average, key price levels, key Fibonacci retracements. If we start going through those levels and either, you know, having a mild bounce and then going back down again and cutting through them, or just slicing through them like they're not there, something else is going on, and that could open the door up for that much larger move down. So let's not get ahead of ourselves now. Let's just watch this near-term range and see where we break out of. I've given you some levels. Of course, the recent highs would be the levels there. We've been failing so far at that purple line. And you know, I gave you some levels on the 60-minute chart to watch from below, but there's just, I'll tell you, a lot of evidence. I mean, there's a lot more evidence now than there was back here for a correction, and I thought there was decent evidence for a correction there. So sometimes the charts play out, sometimes they don't. We had a correction more in time back then, so we'll see this time around if we do play out, and if so, I'm still looking at a correction at least 4 to 5% pullback, and again, quite possibly much more. So I'm very open to that. We'll just see how it looks once it starts to develop. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.